Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So that can be a nice opportunity. Now, at the same time, though, if we were to have gone below that support level and kept going down, now we have another role reversal in which the former level of support is now going to act as resistance. So more basic terms, what used to be the floor is now going to be the ceiling. And if you look back, especially at a lot of the currency charts, you'll find that there's going to be a lot, they tend to obey some of the technical rules a little bit better than stocks. Like take, for example, Apple. Of course, I had to mention Apple to what happened yesterday. Very interesting after-hours news. They released earnings. They have just a blockbuster quarter. Best they've ever had, but yet there was some language in there that they're slowing their pace of iPad sales or something like that. From a technical point of view, that chart was looking like it was going to continue to move up higher, but here we had some news that came out of the blue, not really out of the blue, but it was planned. The news was, but people didn't know what was going to be contained within the news story. Market didn't like it, sold off. You see, currency news, Forex news, does not come out like that. It's not the kind of thing where Steve Jobs says this or that. We're talking about countries. We're talking about trillions of dollars. So the news is not quite as fickle as, hey, we only have a 3-week supply of iPads in stock versus a 5-week supply. You know, it's amazing to me that that small bit of news can move a stock like Apple so much. Usually the news around currency is much more major and more, I can't say more predictable, but it's not as fickle.
Well,
so
shall we say that
Go ahead.
I was going to say, shall we say that Ben Bernanke had better not come out with too many traumatic surprises, because that would rock the markets.
Yeah. I mean, look, come on. Look, we're talking about China increasing interest rates. That is something that involves many trillions of dollars versus a 3-week to 5-week supply of iPads. I mean, come on. That's pretty fickle news versus what's coming out of China here. You know, that's the kind of news that moves economies. You know, the Apple news is the kind of thing that moves traders. Is really about it.
You know, in Apple's move toward global domination, a 3-week supply of iPads in their expectation would amount to trillions of dollars.
Yeah, I guess the way it would. And you still have to buy one, so there you have it. That may move the stock again back to the upside.
I'm ready to throw my hat into the ring, too. All right, excellent. You seen any questions coming in yet, Shawn? I'll go ahead and
no, but you know, I'll bet you they're going to roll in when we get to some of the charts here.
Absolutely. All right, well, let's pick up on some technical indicators. We're going to just hit a couple basic ones here, but the first, what we would consider to be the bread and butter indicators that we use in pretty much every chart that we look at are going to be the moving averages. Moving averages, let me just hit a couple of key concepts behind the moving averages, and this will apply to all of the moving averages. Number one, they are designed to be trend-following indicators. What that means is that if the price is in an uptrend or in a downtrend, they do a pretty good job of what they're designed to do, and that is provide support and resistance and show us the trend. But you have to be careful, because we're seeing a lot of markets right now start to shuffle sideways. When the market moves sideways, when the price action that you're looking at is in a channel, it's consolidating, then the trend, there's really not a predominant trend, and therefore a moving average starts to lose its effectiveness. Now, a lot of people don't really pay attention to that. You know, they say, well, you know, the 50 or the 200 or whatever it might be, the moving average is a really good indicator, and I would say, well, it is in the markets for which it is designed. But if you try to use the moving average in a sideways market, really what you're trying to do is use a hammer to put in a screw. It's not what it's designed for. So you can find yourself making some bad trading decisions. So just be aware, number one, moving averages are designed as trend-following indicators. Number two is they're designed to smooth price volatility. It's why we choose different moving average periods, whether it's a 20, a 50, 100, 200, whatever it might be. The bigger the number, the more smoothing that occurs. Now, to kind of generate a picture in your mind, think about if you were to draw a line chart on the closing price. Well, every closing price is going to be a zig or a zag on that line. what the moving average does is it takes that volatile line and it just stretches it out a little bit to make it smoother. That's where its utility comes in. When the price is above a moving average, as a rule, the moving average will tend to act as support. So the price, you'll oftentimes see price drop down to a moving average and bounce back up. Likewise, when the price is below a moving average, that moving average will tend to act as resistance. So that's one of the things that moving averages do for us, is that it helps identify support and resistance levels. So you recall just a moment ago I said one of the non-negotiables that you have when you're using candle patterns is that you have to have a readily identifiable support or resistance. Well, how do you do that? One of the key ways we do that is with key moving averages. Now, you can vary the time period, as I just discussed. You can use really pretty much any time period you want, and you can change the type. Now, we're only going to introduce you to a couple here, and very quickly then we're going to move on to some live charts. But there are a number of different types of moving averages. I would say try to stay, if you're just getting started with these, stick with the simple. Don't get carried away, even though most trading platforms will allow you to get pretty complicated pretty quickly. That's not always a good thing. But what time periods? Well, when you look at our charts, you'll see that we typically like to start with the 50 and the 200-day moving average. It's pretty simple why. The 50-day moving average is a good approximation for the number of trading days in a quarter. And the 200-day moving average is the one that everybody watches. It's kind of one of these where you may not agree with it, but you certainly ought not ignore it, because if everybody's watching it and trading around it and it's going to influence their trades, well, you need to know where that is also. Let's see. I see a question comes in real quick. Len says, do you ever try to curve fit the moving averages along swings in a trending market? Len, I can already tell you're just a little bit further ahead than your basic trader, so let me just give you this answer. If you're seeing swings in the market, particularly cycles, while we're not going to talk about it today, the moving average that I would recommend for you would be the displaced moving average. The displaced moving average is going to be a simple moving average which shifts to the left or right, but in doing so, it allows you to smooth correctly but still place it in the right location so as to accommodate those swings or cycles in the market. So I would encourage you to take a look at the displaced moving average and see how that works out for you. Philip says, I can't tell the difference between the SMA and the EMA. Philip, about ready to go into that for you. So, watch here in just a second. Next up, okay, there we go. First up is the simple moving average, or the SMA. Now, don't get too excited about that equation on there. That's simply to tell you that the way we find this is by adding up all the closing prices and dividing by the number of periods. So a 20-day simple moving average is very straightforward in that you take the most recent 20 closing prices, add them all together, and divide the sum by 20. Simple as that. The simple moving average is the one that we like to start with. That's, in fact, we use that more than anything else generally. So that's the simple moving average. Now, I'm going to switch over here, and some of you are going to say, whoa, what in the world is all this? Well, what this is designed to scratch the itch of the technical people who are on the call and just can't stand not having an equation in front of them. But here, let me just say this. The exponential moving average, you can either take a look at this equation and satisfy your hunger for calculations, or let me just tell you the difference. An exponential moving average is considered a faster or a more sensitive moving average. Here's why. The simple moving average considers each data point, each closing price, to be of equal value, not equal number. The closing prices will be different, but each one is considered just as important as the next.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.